Most people think their Social Security check belongs to them. They paid into the system for 30 or 40 years, and now it's just their money returning home. But there is a specific income threshold, a cliff that changes everything. For a married couple, that number is $44,000. Now, once your combined income crosses this $44,000 line, you enter a tax zone where the math stops making sense. You might decide to withdraw an extra $1,000 from your IRA to pay for a car repair. But just know, because of how the IRS calculates this specific trap, that single $1,000 withdrawal doesn't just add $1,000 to your taxable income. It can actually increase your taxable income by $1,850. $1,000 withdrawal equals $1,850 taxable income. You pull out $1 but get taxed on nearly $2. This is the Social Security Tax Torpedo. It destroys retirement budgets every single year, not because people are wealthy, but because they didn't know the formula. Don't worry, today we are going to fix that. The trap, provisional income. The reason this catches so many retirees off guard is that the thresholds haven't been updated since 1993. Think about that. The price of bread, gas, and housing has skyrocketed, but the line where the IRS starts taxing your Social Security benefits has stayed exactly the same for over 30 years. To understand if you are safe, you have to understand the metric the IRS uses. It isn't your adjusted gross income. It is something called provisional income, AGI plus tax-exempt interest plus 50% of Social Security. The formula looks like this. It's your adjusted gross income, that's your pension, your wages, your IRA withdrawals, plus any tax-exempt interest like municipal bonds. And here's the kicker. You have to add back in 50% of your Social Security. 50% of Social Security if that total number, your provisional income, is under $32,000 for a married couple. Your Social Security is tax-free. You keep every penny. Between $32,000 and $44,000, up to 50% of your benefits become taxable income. But once you cross that $44,000 cliff, up to 85% of your Social Security benefits become taxable income. Now, those numbers might sound low to you, and that is exactly the problem. It's very easy to accidentally trip this wire without realizing it until April 15th. Let's look at this real-world scenario. Bob and Sue. Let's get out of the abstract and look at a real-life example. We're going to look at Bob and Sue. Bob and Sue are 66 years old. They've done a good job saving, but they aren't ultra-wealthy. They just want a steady, calm retirement. Between the two of them, they collect $40,000 a year in Social Security. Now, let's say their basic living expenses are covered, but they need an additional $20,000 a year from their traditional IRA to pay for groceries, utilities, and travel. Let's run the provisional income test on them right now. They take $20,000 from the IRA. That is their adjusted gross income. We add 50% of their Social Security. Half of $40,000 is $20,000. So $20,000 IRA plus $20,000 Social Security equals a provisional income of $40,000. They are in the middle zone. They are between $32,000 and $44,000. In this scenario, only a small portion of their Social Security is taxable. Specifically, about $4,000 of their benefits would be subject to tax. Given the standard deduction for seniors, Bob and Sue likely pay $0 in federal tax in this scenario. They are living tax-free. Isn't it wonderful? Now, keep in mind, this is the before picture. Everything looks fine. But now let's look at the after. Sue decides she wants to renovate the kitchen, or maybe Bob needs a new car. They decide to take an additional $30,000 out of the IRA this year. They think, okay, we'll pay tax on that $30,000 withdrawal. That's fair. But watch what happens to the math. Now their IRA withdrawal is $50,000 total. We add back that same 50% of Social Security, $20,000. Their provisional income is now $70,000. They have blasted right past that $44,000 cliff. Not good. Because they crossed that line, two things happen simultaneously. First, yes, they owe income tax on the extra $30,000 they withdrew. But second, because their provisional income is so high, suddenly 85% of their Social Security checks become taxable income. In the first scenario, only $4,000 of their Social Security was taxable. In this new scenario, $34,000 of their Social Security is taxable. Just look at the split screen comparison. Left side, taxable Social Security, $4,000. Right side, taxable Social Security, $34,000. Do you see what happened? They withdrew an extra $30,000 of their own money, but their taxable income didn't go up by $30,000. It went up by the $30,000 withdrawal plus an additional $30,000 of newly exposed Social Security income. Their taxable income jumped by $60,000 just because they took out $30,000 cash. I know, you didn't do anything wrong, but this is the double tax effect. For every dollar they pulled out in this specific range, nearly $2 got added to their return. Instead of being in the 12% tax bracket like they thought, they are effectively paying a 22.2% marginal tax rate on that money. Or in some brackets, a 22% bracket becomes a 40.7% effective tax rate. That is the shock. That is the torpedo. You think you're spending your own savings, but you're actually unlocking a tax bill on money you thought was already yours. I know, but remember, panic is not a strategy. Now let's look at the freedom salary solution. The goal of the freedom salary isn't to be rich, it's to have clarity. Now that you see the cliff, you can navigate around it. Here are the 3 ways we handle this. 1. The Roth release valve. Roth conversions and withdrawals. This is why I talk so much about Roth conversions. Distributions from a Roth IRA do not count towards provisional income. If Sue had taken that extra $30,000 for the kitchen from a Roth IRA instead of a traditional IRA, their provisional income would have stayed low, their Social Security would have remained tax-free. Having a Roth account isn't just about tax-free growth, it's about having a way to access cash without triggering the torpedo. 2. Timing withdrawals. If you need a large lump sum, consider taking it in a year where you have massive deductions, or spread it over 2 years. Don't take $30,000 in December. Take $15,000 in December and $15,000 in January. Keep yourself under the $44,000 provisional income line if possible. 3. The QCD strategy. Qualified charitable distributions. If you are over 70.5 and you give to charity, do not write a check from your bank account. Give directly from your IRA using a qualified charitable distribution. This satisfies your RMDs but never hits your adjusted gross income, meaning it keeps your provisional income lower. The tax code isn't designed to be fair, it's designed to be a series of rules. The $44,000 cliff is a harsh rule, especially since it hasn't changed since 1993. But if you know it's there, you don't have to fall off it. Look at your last tax return. Find your provisional income. See how close you are to the edge. If you want to understand more about how to build that tax-free release valve and avoid the tax torpedo I mentioned, I've linked Morningstar's resources in the description if you'd like to dig a little deeper. And if you enjoy calm, clear explanations, you'll probably like our other videos too. Be sure to like and subscribe for weekly updates. It's not about hype, it's about keeping the money you've earned. And as you can see, there are ways to do it. You've got this. Thanks for watching.